Hello, everybody. This is Patrick MontesDeOca with the weekly Seeking Alpha report published May 11, 2018. Gold is ready for takeoff. Summary. Our analysis suggests that the dollar is potentially beginning to confirm that we have made some sort of a short-term to intermediate top. I am doing this special report because the VC PMI strongly suggests that we are at a significant turning point for the dollar and precious metals. Gold has been trading in the 1300 to 1310 range for the past few weeks and has established a major reversal to the upside, on a close above 1325. US dollar short-term top. In this intra-week special report update, I want to review the US dollar, which is currently trading on 92.59, down 20-30 points. Our analysis shows that the dollar is potentially beginning to confirm that we have made some sort of a short-term top. In the previous articles on Seeking Alpha, I have argued that the US dollar has been in a major downtrend, as you can see from the long-term charts dating back to 1971. More recently, we have established some kind of a bottom around the 88.50 for several months, particularly since the beginning of 2018. What we saw here was a breakout above the 90 area, which activated the uptrend and potentially a swing rally to the current levels. In the 93.20 area, the high of May 9th was 93.56. The variable changing price momentum indicator, the VC PMI automated algorithm, which we use to identify major turning points in a range of markets by calculating the extreme volatility of a given market. It identifies specific pivot points at which day swing long-term traders can enter and exit the market. We have applied the VC PMI to the dollar as well as many other markets. I'm doing this special report because the VC PMI strongly suggests that we are at a significant turning point for the dollar and precious metals. I believe that we are at a point where events and trends are going to have a major implication, especially since President Trump canceled the Iran nuclear deal, increasing the risk of a conflict in the Middle East and causing a tremendous uncertainty in the crude oil market. With the price of crude reaching over $70 a barrel, this is not a good change for the world economy. Crude oil trading above $70 is another indication that we are beginning to see inflationary pressures begin to build up in the global economy. Depending on how long oil trades above $70 and how high interest rates rise, with the 10-year Treasury note now above 3%, the U.S. monetary policy is driving interest rates higher in the face of record levels of global debt, particularly in the U.S., which exceeds 100% of GDP. It is really difficult scenario to accept that all these economic and geopolitical policies are going to have a positive effect on the world economy. We already are beginning to see deterioration taking place based on some of the economic numbers that came out last week. Weak economy. ADP reported the weakest job gains in a long time, the biggest miss in 7 years. The job situation is not doing well. The numbers have been manipulated for years to try to make everyone believe that the economy is doing well, but nothing has really changed. What has changed is what the real economy is doing. We are in a recession or headed towards another recession. Automaker. Auto market crumbling. Retail GDP and many economic indicators show that everything is starting to fall apart. Retailers, restaurants, and auto dealers are not showing expected profits. Auto dealers have been selling cars to subprime people, and now they can't afford cars. Ford is planning to cut $25.5 billion in cost cuts by 2022. Ford will attempt to reduce its business while cutting a lot of jobs. The smaller subprime auto lenders are starting to implode. Largest lenders will be next, and then the whole system could collapse, which is why car companies are trying to cut costs. They are trying to learn from 2008, when many car companies such as GM kept spending, taking out more credit. Then the auto market collapsed and they were forced to cut. Saturn and Pontiac disappeared. Housing on the verge of a potential downturn. In the housing market, mortgage rates have jumped to 2011 levels. A 30-year mortgage rate with 20% down jumped to 4.8% for the week ending April 27, up from 4.66% just 2 weeks ago. According to the Mortgage Bankers Association, at a 4.8%, a 30-year fixed rate will be equal to the highest rate in 2013. At 5.2%, it will be the highest level since 2010. If it hits 5.5%, it will be the highest since 2008. Before 2008, interest rates were going up, and then in 2008 they began to fall. Just before everything fell apart. We are now approaching the 2008 rate. In a couple of weeks, we are probably going to hit it, which will push a lot of people out of the housing market. The big difference between 2008 and now is that home prices have skyrocketed by more than 50% in some markets, such as Dallas and San Francisco. The Case-Shiller home price index is up between 25 and 40%, depending on the city. People who have lost jobs or lost full-time jobs and gone to part-time or lower-paying job, as well as others, no wage increases, can't afford these homes. Fannie Mae allows 3% down who had not seen a raise in years, are no longer in the housing market. Soon we're going to see zero down mortgages, which is the sign of the Fed. The end, basically. It's a sign of the end. For the week of April 27th, mortgage applications were down 2.5%. And they are going to continue to decline because people are being thrown out of the market, which will then fall apart. I feel very strongly that we are going to see the tremendous pressure based on interest rates and the rising cost of oil, taking away any positive benefits from the tax plan that was implemented by the current administration, which might have had some positive short-term effect, but it's creating a tremendous gap in the trade deficit long-term. These factors are an alarm signaling to me that you have to take into account the position of the dollar in terms of its technical position, fundamental, and geopolitical analysis. You have to conclude that you have to move away from the US dollar and diversify into other assets. Global tensions in the gold market, a buying opportunity. Gold has been trading in the 1300 to 1310 area for the past few weeks, and based on the VC PMI analysis, we have been suggesting in our Seeking Alpha reports that you should buy into these levels to cover any shorts, particularly in the 1303 to 1304 area. The gold market is sending a clear signal that the VC PMI, basically through the VC PMI, that you should implement some of these strategies to go long if you get a chance and opportunity at these levels. In the gold and silver futures report that we published this past Saturday on Seeking Alpha, we gave you some idea of the levels that we expect a mean reversion to take place. And our subscribers had the opportunity to receive this information before we publish it in Seeking Alpha or made available to the public. With the gold market closing Friday at 1315 and using the first filter of the VC PMI report, the 9-day moving average, which was at 1332, that the filter came into this week slightly bearish. But the VC PMI also tells you that if the gold market closes above 1332, that it would negate this bearishness to neutral position. And this is the first pivot point or stop. If you shorted the market, which gives you an indication that the trend momentum is turning from bearish to neutral, then the second close about 1332 would activate a buy signal. The second filter that we use in the VC PMI is the average price, which is at 1314. With the market closing about 1314, we came into this week with a bullish price momentum. Once we extrapolate from this pivot point, the VC PMI, it tells us that the extreme above or below the mean. If we were to close below 1315, it would negate this bullish sentiment and the market would turn neutral. By closing above 1314, the market has activated the sell one and the sell one level of 1326 to 1338, which is the sell two level. It suggests that you should lighten up or take profits, as the sell one level is the extreme above the mean of 1314, and the sell two level is the second level of the extreme above the mean. If the market comes down below 1314, it activates the buy level of 1303 to 1291, which is the buy one and buy two level, or the extreme below the mean. As we came into this week, gold made a low yesterday of 1304, coming right into this level of demand. For the past few days, it appears that this level of 1302 and the low made of 1302 on May 1st has been holding. With the test of yesterday at 1304, we are now in a rallying from these levels to 1323 and above, moving into this supply zone. Closing above 1325 is going to be extremely bullish because it is kicking in the longer term trends on the weekly and monthly levels. My conclusion is that the market is sending a clear signal confirming that the VC PMI forecasts the precious metals are on the way to reaching the original targets that we published in Seeking Alpha back in October of 2017 of 1385 to 1484. The additional confirmation is that the dollar is topping out. If in fact the dollar does follow through to the downside, it is going to precipitate a very bullish signal for commodities in general. In precious metals in particular, it appears to be an excellent time to buy into the gold in silver markets. If you would like to receive more information about the Equity Management Academy and the VC PMI automated system, feel free to reach out to us, email support@ema2trade.com. My phone number, you can reach out, is 877-733-1511, US toll-free number, or the direct line is 805 area code -418-1744. Direct online support, Skype ID, EMA with a digit number, 2trade.com. That's Skype ID, EMA2trade.com. Once again, this is Patrick MontesDeOca. Until next week, my friends, be well. Good trading. I'll see you then.